As you know, this channel is about building a portfolio that pays your bills. But what does that really look like? And how can you actually do it? A lot of people who clicked on the title of this video are probably hoping I'm going to tell you a quick, nice, round, achievable figure. Unfortunately, the bad news is it's not that easy. The good news is the calculation I'll show you helps you to have a personalized number for you and your financial situation. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. Imagine waking up knowing your basic living expenses are already covered, not from some huge inheritance or lucky lottery win, but by the fruits of a year's worth of efforts you have put into your investments. No alarms, no bosses, no fear of losing your job at the next round of layoffs. You get regular income hitting your account, allowing you to live with freedom and peace of mind. This isn't just a daydream or fantasy for many people, it's the true essence of living off dividends. This investing strategy is a way to reclaim your time and choices. And when you combine it with the concept of the minimum viable lifestyle, the MVL, which we'll come to later, it becomes not just achievable, but also highly personalized to your own circumstances and practical in terms of building. The dividend income lets you fund your essentials, reduce stress, and unlock new earning opportunities and possibilities. But the key isn't to aim for riches, it's to aim for enough. That's what the MVL helps you to define. But before we get into how to calculate your MVL, we need to be clear about the foundation. What does it mean to invest in dividends? What are dividends and why do they matter? Dividends are payments made by companies to their shareholders, typically drawn from profits. When a business earns more money than it needs for day-to-day operations and reinvestment, it often returns some of that excess to its shareholders. These payouts are called dividends and are usually distributed quarterly, though some companies pay monthly or annually or semi-annually. Investing in dividends means buying shares in companies that regularly pay out part of their earnings. Over time, these payments can form a stable stream of income. If you build a portfolio of such dividend-paying stocks, it's possible to live off the income they generate, much like living off interest from a savings account, except that dividend yields are often significantly higher than what banks would offer. Unlike capital gains, which depend on the market price of a stock rising, and therefore can be unpredictable, dividend income tends to be more consistent. And for long-term investors, reinvesting dividends can dramatically boost returns thanks to compounding. Eventually, the snowball effect kicks in. Your dividends buy more shares, which generate more dividends, and so on and so forth. And this is why dividend investing appeals to those seeking financial independence. It prioritizes cash flow over speculation. Rather than hoping your shares will be worth more in the future, you're focusing on what they can pay you in the present now. So, how much of these investments do you need? First, you need to understand the concept of the minimum viable lifestyle, the MVL. This ties directly into the metronome portfolio approach that I came up with. In that model, the MVL is supported by the base layer of the portfolio, steady, dependable dividend income that provides balance. Just like the weighted bottom of a metronome keeps it ticking evenly, this base keeps your financial life steady and predictable, even when markets fluctuate or life takes unexpected turns. If you're not sure what the metronome portfolio is or want to learn more, I made a more detailed overview on this video. And that's worth watching for a full understanding, but we just want to cover one aspect of it in this video, the MVL. The minimum viable lifestyle, or MVL, is the baseline version of life that you're willing to accept without losing your sense of security or sanity. It's not about poverty or self-deprivation, it's about sustainability. So it's about asking what is the lowest cost version of life I could genuinely tolerate if I didn't want or couldn't afford to work. For some, this might mean living in a modest one-bedroom flat, cooking at home, ditching non-essential spending. For others, especially those with families or health concerns, it might involve more. The point isn't to hit rock bottom, it's to establish a realistic floor that you could stand on. Let's bring this to life with a more concrete example. Imagine you're a single adult living in Nottingham, a regional UK city known for its relatively affordable cost of living. Here's what a realistic monthly budget might look like for a no-frills but dignified lifestyle. Rent, or a one-bedroom flat, £625. Utilities and council tax, £150. Groceries, home-cooked meals, bulk buying where possible, £200. Transport, monthly bus pass or minimal car usage, £50. Phone and internet, £30. Basic clothing, toiletries and miscellaneous essentials, £70. So that totals £1,125 per month, or £13,500 per year. It's not luxurious, but it covers everything you genuinely need to live securely and with a level of self-respect. Now extend this thinking to the portfolio level. Imagine your investments are consistently producing £1,125 each month in dividend income. Time to hit your account as close as possible to when the bills come due. Every rent payment, every grocery shop, every Wi-Fi bill is handled not by the proceeds of your labour, your work, but by the quiet rhythmic tick of your dividend portfolio. This is the metronome in motion, steady, reliable, and entirely yours. That's why your MVL is financially covered, and that's the milestone that we're aiming for here. Why MVL matters so much. Without the minimum viable lifestyle, financial independence can feel vague and endless. Retire early or get rich don't offer clear, actionable targets. But when you know your MVL, you know exactly how much passive income you need. It makes the abstract concrete. Once your dividends cover your MVL, you're not dependent on a paycheck anymore. You may still work, but it's not out of desperation. All the work you do now is simply to improve your life as your baseline costs are already covered. You also gain optionality, the power to say no to things that you'd prefer not to, if you didn't need to do it for income, to change the direction in your career, or to take risks with a side hustle or something like that. That's the first taste of true financial freedom. For some context and possibly inspiration, I wouldn't have been able to start this, successful by most people's measure of that, YouTube channel, to this point today if I wasn't supported by my dividend income during the rougher patches or the more periods of less reliable income. And if you're thinking about getting started with investing and want a simple platform to begin building your dividend portfolio, then the broker I personally currently use might be worth checking out. If you're a new user or even signed up within the last 10 days, check the video description for the most up-to-date promo code and free fractional shares sign-up offer. I usually don't mention specific codes in the video itself because these offers change over time, and it's much easier to update details in the description than to re-edit the video itself down the line. But that still leaves the question, how do you do it? Building the dividend portfolio base. The dividend income that supports your MVL comes from what I call the base of your portfolio. Think of it like the bottom of a metronome, the part that stays stable. This base isn't about speculation or high-flying growth stocks. It's about income, predictable, sustainable, and comforting income. This part of your portfolio is made up of specific types of investment that are designed to generate regular payouts. A few categories of these include dividend-paying stocks, and these are shares in companies, often well-established and profitable, that return a portion of their earnings to shareholders. Some companies have a long tradition of doing this consistently, even increasing the amount they pay year after year. These are sometimes categorized as dividend growers or dividend stalwarts because of their reliability and longevity in maintaining payments. These companies are typically in sectors like consumer goods, utilities, or healthcare, where demand remains steady regardless of the economic cycle. Another category could be real estate investment trusts or REITs. These investment vehicles are structured to own or finance income-generating real estate. They might include residential buildings, commercial offices, hospitals, warehouses, or shopping centres. REITs are legally required to return the majority of their income to the shareholders, which makes them a strong candidate for dividend-based strategies. Because they operate across different parts of the property market, they also offer diversification within your income stream. Then you could also have dividend-focused ETFs and funds. For those who prefer a hands-off approach or want broader diversification, dividend-focused funds or ETFs bundle together dozens or even hundreds of dividend-paying companies. These funds are typically designed to target either high-yield companies or firms with a strong track record of growing their dividends over time. They reduce the need for constant monitoring of individual stocks and smooth out the income risk by spreading it across many different sources. During the accumulation phase of building your portfolio, many investors reinvest these dividends automatically to buy more shares, which helps compound growth over time. But once you reach your MVL target, those dividend payments can shift from reinvestment to real-world spending, paying your rent, your bills, and your essentials. But how do you know when you've reached it? First, you need to determine your target yield and portfolio size. To figure out how much capital you need to live off dividends, start with two key numbers: your MVL, minimum viable lifestyle annual cost, and your expected average dividend yield. Dividend yield is the percentage of your investments you receive as income each year. For example, if you invest £10,000 in a stock or fund that pays £500 per year in dividends, the yield is 5%. Let's go back to the earlier example of someone living on £13,500 per year. You can use the following formula. Required portfolio equals MVL divided by dividend yield. So for different yield targets, at a 4% target yield, you'd need a total portfolio of £337,500. At a 5.5% yield, you need a total portfolio of £245,000. At a 7% yield, you need a total portfolio of £193,000. So as you can see, the yield affects the amount of capital required. But there's a trade-off. Higher yields often come with higher risks. Stocks yielding 8 to 10% might look more attractive, but if the payout isn't sustainable, you risk dividend cuts, or worse, capital losses if the stock itself declines in value. And that's why I would say that income-focused investors should think about aiming for a yield between 4 and 7%. It's high enough to make reaching your minimum viable lifestyle feasible without requiring millions in capital, but low enough to still focus on quality, sustainable businesses. As a practical step, once you've calculated your MVL and your desired yield range, you can begin to reverse engineer your investment plan. If you're aiming for a 5.5% yield and your MVL is £13,500, then a target portfolio of around £245,000 becomes your goal for base level financial freedom. It's crucial not to chase the highest yields indiscriminately. Companies offering 8 to 10% or even higher yields often do so because their stock prices have dropped and the dividend might not be sustainable. So focus on companies with consistent earnings, low debt, and a history of increasing dividends. Geo-arbitrage and lifestyle design. One powerful yet under-discussed strategy to make your MVL more achievable is geo-arbitrage, earning in a strong currency and spending in a weaker cost of living region. If your MVL in the UK is £1,125 per month, that might seem like a tall order in terms of total portfolio size. But in places like Thailand, Portugal, or Mexico, you can enjoy the same standard of living, or better, for half the cost. That means a smaller portfolio can stretch much further. Let's say you have £100,000 invested and it yields £5,500 a year. In the UK, that doesn't go so far, but in rural Vietnam or small town Romania, that might comfortably cover very basic rent, food, and other essentials. Also, I should note that geo-arbitrage doesn't have to be permanent either. A year or two abroad living cheaply could let you live better for less while your portfolio still grows. It's a strategic way to buy time and accelerate financial freedom. Getting from zero to MVL. If you're starting from scratch, don't be discouraged. The path from zero to a fully funded MVL is steep, but it is possible, especially with focused strategy and realistic milestones. The first step is assessing what you already have. Do you have any savings, pension pots or ISAs? Even £500 or £1,000 invested in a very basic dividend ETF can start generating small but tangible results. Those early dividends may only cover a bill or two now, but they're proof that the system works. One effective approach is to set mini milestones tied to real-world bills. For example, your first goal could be earning enough dividend income to pay your monthly phone bill, perhaps £30, and once you hit that, aim to cover your internet costs, then groceries and so on. Each time you fully fund a recurring expense from dividends, it's a psychological win and practical reduction in financial pressure. This strategy transforms abstract numbers into tangible progress and keeps you motivated along the journey to covering your entire MVL. Next, you want to build momentum. Start by setting a savings rate, ideally 20 to 30% of your income if possible, and automate monthly contributions to your investment account. Reinvest every dividend back into more shares to leverage compound growth. Each reinvestment grows your income potential, accelerating progress towards your MVL. Try to use tax advantage accounts as much as possible to shield your dividends and capital gains from tax. Over time, even modest monthly investments can snowball. For example, saving £500 per month with an average return of 6% annually could grow to over £70,000 in 10 years. It's also essential to reduce drag. Pay off high-interest debt like credit cards as soon as possible. Every pound not spent on interest is a pound working for your future. Keep your lifestyle lean to allow more room for investment, especially in the early stages. Transitioning to living off dividends. Once your dividend income reliably covers your MVL, it's time to transition. Instead of reinvesting, you start withdrawing the dividends to pay your actual expenses. Set up your accounts to automatically send dividends to your current account in your bank. Stagger your holdings so that you receive payments throughout the year, not all at the same time. For example, mix companies that pay in different quarters to smooth out the cash flow. Also, maintain an emergency fund. This provides a buffer against dividend cuts or unexpected costs. Even the most reliable companies may reduce payouts during downturns, and you'll want options if that happens. Review your portfolio regularly. Watch for signs of trouble, rising debt, shrinking earnings, or unsustainable payout ratios, and reevaluate your MVL each year. Life changes, and so should your numbers. So to answer the question, how much do you need to retire on dividends? By now, the question should feel more answerable than it first seemed. The truth is there's no fixed number. There's only your number, and it starts with your minimum viable lifestyle. Retiring on dividends doesn't mean hitting some mythical one-size-fits-all figure. It means identifying the lifestyle that you want at a minimum, calculating the annual cost to sustain it, and building a dividend-generating portfolio to meet that cost. If your MVL is £13,500 and your portfolio yields 5.5%, you need about £245,000. If your desired lifestyle later expands to £24,000 a year, you might adjust your portfolio target to somewhere around £436,000. But the point isn't to guess a giant number and hope, it's to reverse engineer from your life up. By breaking your goal down into manageable progressive targets, first covering your phone bill, then rent, then groceries, etc., you'll watch your freedom accumulate one expense at a time. And when your base is fully built, you realise that you haven't just bought income, you've bought your own time back, autonomy, and probably a peace of mind. And this is one of the most frequently asked questions, and the answer depends entirely on your lifestyle expectation. Now let's say your ideal retirement income, so not MVL, but your ideal what you want to have when in retirement, is £24,000 per year. Using the same formula from earlier, required portfolio equals desired annual income divided by dividend yield. At a 4% yield, you'd need £600,000. At a 5.5% yield, you'd need £436,364. And at a 7% yield, you'd need £342,857. So how much you need depends on two variables, your desired income and the yield you're able to achieve reliably. The lower your target income and the higher your sustainable yield, the less capital you'll need. But be cautious about going too far in either direction. It's better to base your target on a modest lifestyle you've calculated and a yield that balances reward with sustainability. And this is why knowing your MVL is so powerful. If your MVL is £13,500, as we mentioned before, and you've hit that number through dividends, you may not be retired in the traditional sense, but you are financially independent at the most foundational level. From there, you can choose to keep building towards a richer lifestyle or simply enjoy the breathing room. Conclusion: freedom isn't far away. Living off dividends doesn't necessarily require you to be a millionaire. It requires focus, planning, and a clear understanding of what enough looks like for you. The minimum viable lifestyle gives you that target. Dividends provide the fuel, and with time, consistency, and discipline, the two can come together to create a life of optionality, stability, and peace. Grow your base, track your MVL, let your metronome tick, and step into a life that pays you back, month after month, freedom after freedom. Build a portfolio that pays your bills. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!